And ladies and gentlemen, boys and girls, and children of all ages, this is the Investor Show. And as always, this is your host, the Prince of Investing, Prince Dykes, coming to you guys and girls live all the way from the beautiful state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button. Drop comments below if you got questions. But as always, I don't have a lot of time, and I definitely know you guys and girls don't have a lot of time, so we're going to jump straight into it. So as you can see this video, we're going to be talking about robo investing. If you don't know what robo investing is, that's like the new hot trendy thing that's been going on now for a little while, where it's like robots that invest for you, where you can just come in and invest or whatnot. But anyway, today we're going to be talking about that exactly with TD Ameritrade. We're going to walk exactly how to set that up and do that with TD Ameritrade, all the ins and out. And also, I'm going to tell you what I think about it and why I think what I think about it. But as always, sit tight. So right here, you go up when you log into your TD Ameritrade account, go to Planning and go to Essential Portfolios, right? Now, when you get to Essential Portfolio, you can read about it a little bit here. Essential Portfolio use innovative technology to build, manage, and automatically rebalance your investment for you. Now, the thing about it is, first thing is you have to have $5,000 to have the automatic investing for you. You know, people that like things like this, maybe a novice investor, someone who's new to investing, who kind of, well, how do I get to invest? I don't know what to buy. I don't know what to do. Instead of going to some big time investment advisor that's going to charge me 1 or 2%, maybe I can get these new low cost robo investors that I do so much lower. They're going to rebalance for me, all of the great stuff like that. So we're going to take a look. First thing you're going to do, hit the green button right here that says, you can look, well, before we do that, you can look at more information, see the pros and cons that they have listed here. But we're gonna walk through that anyway, and we go through what you call. So you're gonna hit the green thing. So it's first gonna ask you, what's your name? How old are you? We're gonna leave it at your name is John. And you're 22 years old, right? Now we're gonna say, why do you want to invest? A large purchase, maybe looking to get a house, maybe investing for your kids. Just hey, I want to invest, or hey, you're investing for retirement. So what you're gonna say, you're going for retirement, right? And you're gonna hit next on that. My minimum investment on my portfolio, because you got to have $5,000 to use this. So if you did, you just leave that up here. I plan to leave this in for, we're just going to leave that. You can move the dates if you want to. We're going to say the longest you can go, right? Once you have that, then you're going to go down and it's going to say how much money do you make and about how much you have in savings. So with this, you're just going to leave it the way it is. With $3,000, you can change it however you want to do, right? But we're going to leave it how it is right here for this walkthrough. And it says, hey, I'm comfortable with a higher amount of risk or lower. So you can say higher, fairly high. And as you change the numbers, let's say if you go to lower, you can see the numbers change. In the worst year, it's a -4. In the best year, it's 13%. So in the best year, it's 13%. The worst year is 4. But if you go to higher, the best year is 27 and the worst year is 15. So it's going to ask you what you want to do. If you're a young person, they're going to say, hey, you should go with a higher risk because you have time to help out and things like that. So, oh, that's Wesley. Come on over here, Wes. Tell everybody, hey. Tell everybody, hey.
Hi.
Okay. So, finishing up this video.
What are you talking to?
I'm shooting a video.
Who's on the radio?
I'm shooting a video.
Who's shooting the video?
I am. Can I finish shooting it up? You got to be quiet while I shoot it.
Yeah.
Okay. So you hit next, right? Once you do that, you're 21 years old and you want to say, hey, what you want your portfolio to grow to? You can change this amount to whatever you want to do. We're going to leave it at 18,000, right? Now, once you do this is going to put you into an aggressive portfolio with a retirement target of $18,000. Your initial investment is $5,000. This aggressive portfolio is weighed heavily towards equities, which provide a significant growth increase but has risk. So 51% is going to be in domestic equities. They have you in some international equities, some domestic fixed income, more like your little bonds, some international bonds, some emerging markets, and a little tiny bit in cash, right? Not too bad. It says it's available Expected average return is 6.7. Aggressive, low advisory fees of 0.30, right? So now when a person see this, you go in here, you click. This is one thing I look at. Historic returns. The historic return, SPI, is 26.63%. This means, SPI means, right here, we can see it, so you can't say I'm making something up. Since portfolio interceptions of April 30th, 16, this portfolio has returned 26%. And now it's saying returns are net advisory fees. So it's saying that, hey, after the advisory fees, since this thing has started in April 30th, it has returned 26%. Now, this is the thing about it. I looked up the S&P 500 in the same time frame from April 30th to now, present day. The S&P 500 has done 37%. 37%. So this tells you that this has underperformed. The most aggressive portfolio has underperformed, and it has an advisory fee of 0.30. If you went and got a index fund, you can get an index fund for 0.03. That would be someone who is paying 30 cents for every dollar invested versus someone who's paying 3 cents. So if you get a low-cost index fund, you can, in this time frame, the index has outperformed it for a lower price. And this is the most aggressive fund. Excuse me. So that's why I look at it as a no bueno for me. Is looking at it as like, hey, well, you're underperforming the market and your fees are exceptionally higher, but they're low compared to the industry of actual stockbrokers and investment advisors, but you're underperforming. So it's no bueno for me, but that's how you do it. If you want to do it, you hit here, you select the box here, you hit next, and it takes you on to the next phases of actually getting you set up. But that's how the Robo investing, which is called Essentials, with TD Ameritrade works, and that's my opinion. So until the next video podcast or whatever else you see me do crazy around the globe, peace, be safe, I'm out, and thank you.